Futures or forex, which is better for order flow analysis and trading? My name is Michael Valtos. I'm the founder of Orderflows.com. Before I jump into this, brief disclaimer: this presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Okay, so what today's video is going to be about is going to be about futures trading or forex trading, and which I think is better for order flow. And there's nothing wrong with forex trading. There's nothing wrong with futures trading. But there are differences when you're trading futures or you're trading FX. And one of the things I just want to I gotta say it out is I'm a futures guy. I've always been a futures guy ever since I started. I grew up in Chicago, and in Chicago, obviously, you have the exchange, the CME there. You have the CME, the CBOT, which are, the futures exchanges. So, that's why I'm a futures guy. When I got my job, it was on the floor. And, I just happened to be fortunate enough to work in the currency quadrant of the CME. I worked in the Swiss franc and Deutschmark pits. And, so, I do have, I'll say a soft spot for currencies, but, that's where I got started. And, with the advent of the euro back in the late 90s, obviously the Deutschmark, sort of turned into the euro as the main component. But, there's still, the Swiss franc you can trade, the British pound, the Japanese yen, Canadian dollar, Aussie dollar, as well as the euro. But obviously, the euro is I think by far the most popular contract to trade now. So what's the main differences? Well, just real quick, talk about the data. Now, data, when it's coming from the exchange, right? It comes from the CME, on the futures contract. We'll start out first. It comes from the exchange. So, and it's centralized, there's one marketplace, and it just comes from there. Now, with forex trading, you have data coming from different sources. So, I'm going to show, let me pull up a chart real quick here. Okay, so this is an order flow chart in the euro versus US dollar. This is a 5-minute chart. Now, currencies are quoted basically in millions, or I think a trading unit is around 100,000 US dollars or euros. I'm not sure what it is anymore, but so that's why you're seeing these numbers. Like here, you're seeing at the top of this bar, you got 500,000 notional value traded. Here is, what is that? I don't know, 21,100,000, and is it confusing? For some people, yes. There are online calculators that you could go to sort of calculate out what a tick is worth. When you're trading FX, you could trade like these micro lots where, people are drawn to it because they think, oh, you can have very low margin. You have very low margin because you have, extremely high leverage. It used to be like, I think, 400 to 1. I think the last year when the Swiss bank made an announcement, and a lot of people got their accounts wiped out. A lot of firms, especially the ones in the US, FXCM, I think went to margin requirements of 50 to 1 leverage is the most you could have, I think. But you could literally trade it with like margins as low as like $20 or something. But what that means is one tick move is like 10 cents. Okay, but if you want to trade something equivalent to the futures contract, your margin, you'd have to go look at a margin calculator. Okay, so for example, here Okay, this is a margin. Whoops. This is a margin calculator from FX Pro. Okay, it's a UK brokerage. Now, Euro US dollar, the currency pair. US dollar currency. If you say you're trading at leverage of 200 to 1, right, which is quite high actually. I don't even think you can get that. Your margin is going to be $282, and that's on a 50,000 50,000 units. Basically you're 50,000. You're controlling $50,000 worth of euros, and which is what the contract. Essentially, it's around what the contract size. Actually, the contract size. They cut the contract size on the CME euro currency. The 6E was cut in half earlier this year. It used to be, I think, about 100,000 or 125,000, and now it's half that size. I didn't even check what the specs are. I just assumed it was that. It could be 62,500. Oops, 62,500. So even if it was 62,500, it give you your margin of $353, and that's at leverage of 200 to 1, which is insane. Realistically, if you're trading at leverage of 50 to 1, your margin is going to be 1,400. Now, why is that important? Well, okay, so for example, say you have an account at NinjaTrader Brokerage. I'm just using them as an example. Some companies are going to be similar. Might be a little bit less, might be a little bit more. NinjaTrader has relatively low intraday margin. I'm talking about intraday margins, $500. Their initial margin is $3,900. Maintenance margin, $3,500. So if you don't hold the position overnight, you gotta be you be margined up for $3,900, which is a lot more than obviously than 1,400. Okay, but if you're trading intraday, right, your margin is 500. I'm not saying go ahead and ultra leverage yourself to the hilt, but honestly, if you're trading, if you're a short-term trader, you're trading with order flows, you tend to be a bit of a short-term trader anyway. So honestly, to tie up 3,900 is quite a bit. Now again, I'm not advocating to take advantage of leverage, but at the same time, people that have watched me trade, I hold positions for anywhere from a second up to an hour, and okay, yes, something can happen and the market can spike up. Okay, but those are rare. I'll say rare events because they do happen every once in a while. Just as you're sitting at a roulette wheel and you're thinking, well, black won't come up 15 times, but then it comes up 16 times over the next 16 spins. You should have money to back up the full margin for any odd event. I'm not saying put $600 in your account and start trading. No, not at all. I'm just saying, make sure you have the money for the position, and don't think leverage leverage is a tool, but it also can work against you if there's an adverse move and you're going to get stopped out. If you're not stopped out, then a lot of these companies, their risk management tool will just take you out. So if your account gets down to 0, they'll just blow you out of the position. It won't even give you a margin call. It'll force exit you, and then you'll get the thing popping up on your screen saying that you're liquidated, just because your margin isn't there. Which is a good thing. That computers can do that now. Before in the past, you wouldn't get a margin call till the evening or the next trading day. So okay, so that's one thing. So that's the main thing. If you're trading intraday, I think futures is slightly better than than the than the actual cash market. Now, again, so what is you talk about pips. Everyone talks, oh, pips, some pips this, pip that. So you're talking 112.83 to 112.84 is 1 pip in in forex parlance. So what's pip worth? It's $6 or whatever. Roughly. Going back to the handy dandy calendar here. They got a thing. They've got a, where is it? They got a pip calculator. So okay, it's, so say you're trading 62,500 your trade size. It's $6.50 a tick, basically, which is what a tick in the euro currency futures is worth. Now, why is that important? Well, okay, so this is a 5-minute chart. Granted the market's slow at this time, but you're only talking 112.88 to 112 basically 80. So that's 8 ticks, 8 pips, what have you. And what's that worth? 8 times, it's like $50. Okay, that's between 610 and 650. Now, let's look at the futures during that time. I got a futures chart here. Bear with me. And let's make it a little bit bigger. So, what time did I say? 6 o'clock, basically. Where's 6? So here, again, it's in a tight range. It's 08 down to, again, 113 even. So again, it's about the same. Now, going to 716, okay, we hit this high here at 113.16 and sold off to 112. Was that 112.92? So 113.16 minus 112.92. You're talking 24 full ticks, but this contract trades in half ticks now. So it's actually, you can see it here, right? When you expand it, it trades 99 to 99.5 to even. So it's actually a move of 48 ticks from 7, quarter after 7 to 8. What did the cash do? Let's take a look. Quarter after 7. It should be similar. So you're moving from, what is that, 112.90, we'll call it 97, to 112.72. Okay, so, what is that? That's about 25 ticks as well. So, it's very similar. Now, part of the problem, I'll say part of the problem, but one of the, again, the thing with FX is, you can tailor your contract size, and so say you just want to trade $50,000 worth, you want to trade 100,000, you want to trade 200,000, you can. And with futures, you have a fixed contract size. That's what futures are. It's a fixed contract size, which is inherent to futures. Now, okay, I'm running NinjaTrader. I'm running my Orderflows trader software. I'm getting my data feed from FXCM, which I don't trade. I don't trade forex, right? But I've recently added the feed from FXCM because I want to watch it, and I'm starting to pay a bit more attention to see if because I get a lot of people asking me, can I use the Orderflows trader with forex? The cash market, and I'm inherent. The drawback is, okay, for me the big problem is the data, because you would need data from a centralized source, and in the forex market you don't have it. What you have is, okay, most forex brokers, the way they operate is they have a white label product from a bank. It could be ABN, it could be RBS, it could be JP Morgan, and what you're getting in your quotes, your data, is actually the data coming from that bank. And if anybody has spent any time working in a bank trading in forex, you know that you get a lot of different quotes from a lot of different systems. And it's generally close, but if you're trading it, you want your quotes to be the actual quotes you want your quotes on your trading screen, your charting screen, to match your trading screen. So I know when I'm trading futures, what's printing on the chart corresponds exactly 100% to what's trading in the market. When you're trading forex, if you're trading through a white label product for ABN, you're getting your quotes from ABN, on your trading system. But if you have your quotes from, Kinetic in this case, which I'm getting my quotes through, it's the quote feed from FXCM. So unless FXCM is using, the ABN data, it's going to be off. It's not going to be off by much. It might be off by, the problem is it might be off by a few ticks. Okay, and then when you're trying to trade in and out, during the day for ticks, it's your quotes are off. You could be trading, a few minutes behind if that. And I said, if anybody's ever worked at a bank, or traded FX for a bank, you know that the FX quotes are going to be different. I mean, that's how a lot of dealers, there's a good video on YouTube. I can't remember the name, but it was actually made like in the 70s, or not say 70s, maybe the 80s, late 80s, barely early 90s. But it covers, it talks about the FX market. It covers a guy in Asia, a guy in UK, and a guy in New York. And the way the old FX desks were set up was, people would have to do an FX deal, and then all the dealers, the guys say, hey, I need to do whatever, 50 million, cable, British pound, and all the FX dealers would call their other counterparties and get quotes for the market. So it's not one centralized quote. So you could be calling one bank, they're going to quote you different. Bank A is going to quote differently than Bank B. It's not going to be exactly right, but it's going to be in the same area. Might be off by a couple of ticks, and they're always going to be changing it. Because part of how they quote it is based on their inventory. On what the bank is carrying. Now, I know some brokers that offer FX to their clients. They actually have an FX desk that will take the other side of the trade. So, I don't say FX dealers are a bunch of crooks. They're not. They're trying to make a living. But so if they can skew the market into their favor a bit, so say, and you guys probably wouldn't see it, you're trading, on a system, so, it's, you're not going to run into these problems, but, I'm just going to talk about some of the things that I know that happens is, I know this broker that runs an FX desk, for their clients that, have, do a lot of foreign trade, and they need to hedge positions. And sometimes, these, and they allow, speculators to call in. So, sometimes, say the market is, whatever, 22 bid at 24, and they know the guy is going to be coming in to sell. They'll not misprice it, but they'll add in a couple extra pips because they know this person has had a position, we're long and they need to get out now. So, so if the market is 22 at 24, they may quote them, 20 bid because the guy's got to sell it. That's why he's calling up, checking the market, finding a quote. So they're going to often give them a quote off by a tick or 2 ticks, because they could just pick that up. That's pure profit. That's what some of these guys do. I mean, it's is it ethical? No, it's not. But is it allowed? Unfortunately, kind of. Yes. I mean, that's just the nature of the business. I know when I was at JP Morgan, and I have to hedge Korean won, trading, trading KOSPI or KTBs, and you'd have to hedge the position. So I call the FX dealer in Korea to make me market. Hey, I got I got to do like 2 yards of Korean won, and the price, the cash market price I'm seeing quoted on my Bloomberg is different than what he's quoting me. Sometimes if we're trading at the upper end of the day, he may be quoting me a price outside of the range. Maybe the offer's outside of the range by a few pips. What can I do? He's my FX broker. I need to get this trade done. And I say, it's just, I mean, that's how it is. You don't necessarily have, the centralized quotes that you get with, when you're trading futures, because, futures, when you're trading the futures market, you're trading, a centralized market, and all the quotes that you're getting, is everything. That's what people around the world are trading and seeing. Everybody's seeing the same price. Everybody's seeing the same volume. Whereas on the, on the FX, on the cash side, you're just seeing it from that one data provider. All the data providers for futures are going to be providing basically the same data. It's not going to vary because it comes from the exchange and it's what's traded in the market. Whereas what you're seeing for the FXCM feed, is theoretically all the transactions coming through the FXCM trading engine. I mean, granted, FXCM is probably one of the biggest retail brokers out there, so it's pretty, indicative of the market, but it's not the actual, it's not the actual market. You may, you'll see it's 112.90 at 92 at FXCM, but if you call, a bank, and because it's for small size at FXCM, you're not going to get somebody trading, yards, which is in the billions, through FXCM. They'll be calling a bank, and and trust me, if you say, hey, quote me on 2 yards of whatever contract, it's not going to be at 112.90 at 92. For in the billions, you're going to be looking at 112.86 at 112, 94 or something. It's going to be extremely wide. I mean, I don't know. It depends on how you're trading, but that's one of the problems with the cash market in order flow. But I mean, and does order flow follow the cash market? For me, order flow is beautiful on futures markets. Because the data is, I don't want to say legitimate, but what you're seeing has, the volume that you see traded is what's actually traded in the market that everybody's participated at. When it's, when it's not a centralized data, then you don't know what's being traded, by another bank in the FX market here. You only know what's being traded through this one broker. So I mean, I don't know. I haven't used, I don't have an account with FXCM, so I can't tell you if the data is is good enough to take trades with or not. But I do know that futures, yes, it is. And futures, things hold very well. Like, okay, so this is the Delta scalper. Right off the high, it's giving you a sell signal, and it comes right down into this low where you get a buy signal, and then it just goes right back up. You get another sell signal here. It didn't necessarily work out. He's sort of looking for its levels, but you're seeing the same thing. I'm looking for the ratios. You got a divergence with the ratio, and it came off. On, let me get this chart out of the way here. On the well, this is a 5-minute chart. It's not a range chart. I thought I had a 10 range chart somewhere. Give me a sec. So this is my 10 range chart here in the euros, which would match up to the 10 range. I look at a 10 range. I like to look at range charts. I keep minute charts open, but I do most of my trading off of range charts because I like to see how price moves from one level to another, rather than say, oh, it's 9 o'clock, so it's time to form a new bar. But I'm still looking at the same things. A ratio and at a high, for the sell ratio. Now, one of the things that's obviously different is the deltas are a bit goofier in uh, in the cash market, just because of the sheer size. There's a lot of zeros because I said it's trading in units as opposed to fixed contracts. I remember when I was working at at Cargill, there's this guy. Cargill. It's just towards the end of the time that I was there, they had basically brought in a team from Lehman to the special investment groups, SIG, they used to call it, and they would trade. Basically they were stockbrokers, but fancy stockbrokers, I guess. And they think in terms of stocks. And I remember the guy that headed, he didn't know much about futures. He came over by the futures trading desk and he's like, so how's business? Oh yeah, hey, I traded. I was trading Hang Seng at the time, and I'm like, yeah, I traded. I just telling him I sold 50 Hang Seng. He's like, oh, just 50 contracts, and he's thinking, like, wow, you sold like 50 shares of stock, which obviously is not the case. When you're dealing in cash, you're dealing in unit sizes or notional, these big values. So even though you see 7,300,000, a unit size is say the unit size should be around 100,000. That's only 73 lots, so there's not much difference. But I mean, for people that don't understand it, it is a bit more intimidating. If the footprint chart wasn't intimidating enough, when they see a footprint chart of the cash market, there's a lot more zeros. Which are, numbers are way bigger. Yeah, you could probably filter. You could probably cut it down, go into the contract spec. You can sort of take out some zeros, might make it a little bit easier, but it doesn't really matter that much. So so which is better? I said I think futures is better just because the data that you're dealing with is centralized, and I mean that's what you want to be dealing with. A correct, accurate set of data. Like so for example, this high here, right? You got a high. You don't have the numbers look much much different. You got a ratio of 2.9, whereas on the futures you got a ratio of 36. I talk about ratios. I do a lot of these numbers up here. This is what the ratios are. I got the delta scalper here, but you got a divergence. You got a ratio you like, and the market is doing what it's supposed to do. With the cash quotes, the moves are similar, but it just looks and feels a little bit different. You don't necessarily get the same ratios just because the numbers are I mean, it's a ratio, so it shouldn't really matter, but the numbers are going to be different just because the people that are trading it's sort of a different beast. The big hedge funds aren't trading through FXCM, right? But the hedge funds that are or CTAs, whatever, CTAs are trading the futures contracts. They're not trading through FXCM. They're not trading through the small retail brokers front ends. They'll call an FX desk to execute their trades. So in the end, which is better? I think futures is. But I'm a futures guy, so I'm a bit inclined to it. I wish that I could say I think the cash market works great with order flow, and it kind of it works, but I just think futures give you a better representation of the market rather than the cash. I'll say the cash market. Futures definitely better than the cash, but as far as order flow going, as far as order flow trading, trade the futures rather than the cash market. I said the margins are similar. Intraday, you're going to get, you're going to use your capital much better. I'm an intraday, I'm a short-term trader rather than, I don't hold anything overnight. If I did, it'd just be an option position. but it'd be something I bought. You know, it wouldn't be anything I sold. And you know, again, I just think, you know, because what you're seeing in the futures, I think the quotes, you know, the data is, you know, is what everybody's traded in that market, whereas in the cash market, you know, through the FXCM feed is what people traded through FXCM. So, you know, you got to make the decision what's better for you. I said I just think that the futures is better. But again, you know, I'm a futures guy, so I'm a bit more inclined to say futures is better. But so anyway, you know, I don't know if that just confused people more, or you know, or I was able to answer some questions. But I think, you know, the main big difference is the data, and that's obviously a key to trading, is having good data. If your data is not 100% accurate, then, you know, you're gonna suffer, and you're gonna make you know, poor decisions. So, you know, thank you for watching this. So for more information on order flow trading, visit my website, www.orderflows.com. Or, you know, if you want to send me an email, you can. It's Mike@orderflows.com. It's Orderflows with an S. So, you know, again, any questions, you know, I'll do my best to answer. But this is one of the questions I get quite often is, you know, hey, I trade forex. You know, honestly, I don't see any value in trading, you know, these micro lots on forex in the cash market when, you know, you're trading with margins of $25, but each tick is worth 10 cents. And what's the point? Yeah, I can understand that maybe you want to, you know, get used to trading or something, but, you know, you could trade a futures contract. You know, there's micro lots in futures. I just think that you know, it's kind of frustrating. I see these people posting online, oh yeah, hey look, making pips left and right, and then you look at their account size and they made like $2.60. You know, I mean, if they're such a, you know, big traders, hey, you should be, you know, trading a you know, a legitimate market, but an organized market. So anyway, you know, don't throw stones at me. You know, I said that's just my opinion. You know, take it or leave it. But if you have any questions, just contact me. Thank you. Bye-bye.